You're listening to Economics Detective Radio. Returning to the podcast today is George Bragues of the University of Guelph-Humber. He has recently published the book Money, Markets, and Democracy, Politically Skewed Financial Markets and How to Fix Them. We'll link to that at economicsdetective.com/money. George, welcome back to Economics Detective Radio.
Great to be back.
So your book looks at the interaction between democratic politics and financial markets. In your introduction, you quote the Greek Prime Minister Alexi Tsipras, who claimed that democracy cannot be blackmailed. And this was in the context of the 2015 bailout referendum that would have helped pay some of the massive Greek debt, but at a cost of forcing them to adopt fiscal austerity. So can you talk a little bit about that situation and how it played out, and also what it tells us generally about the relationship between democracy and finance?
Yeah, sure. That situation has its origins about a year or two after the financial crisis of 2008. The financial crisis of 2008 initially arose out of the subprime mortgage sector in the United States. It affected banks worldwide that were holding or were otherwise exposed to these subprime mortgage assets. But then, as one of the spillovers of this crisis, we had pressure on countries in Southern Europe, including Portugal, Spain, and Greece. And so it all came to a head in 2010. And back then, it was Nicolas Sarkozy and Merkel, Germany's chancellor, who's still around, was a player. And they came up with a framework to bail out these countries, including Greece. So as part of those bailouts, Greece had to comply with various conditions, including the fiscal austerity measures that you mentioned. There was some privatization that had to be done, but it didn't go so well. And so in 2015, early 2015, if I got my dates correctly, Tsipras, who was leading what was then a sort of outsider party, not one of the two major parties in Greece, won. And so they thought that they would take a different approach to the previous Greek government, which was to play ball with mainly Germany. Instead of playing ball with Germany and trying to institute measures to get their budget under control, they thought that they would try to essentially threaten a breakdown of the financial system, a breakdown of the euro, unless Greece were forgiven their debt or otherwise given more lenient measures. The European establishment wasn't buying into that. So this is when Tsipras went to a referendum on a bailout package. He won that vote. That is to say, the Greek people voted resoundingly against the European establishment at the time. But that ended up not really mattering. The European establishment said, basically, we want our debt paid. We're willing to renegotiate the debt, and you have to comply with these conditions. And so that was a situation where democracy and the markets came into play. The Greek government was hoping that by creating a crisis in the markets through a democratic act, one of the most democratic acts that you can imagine, which is a referendum, because in a referendum, the people vote directly on a policy, that they were hoping that democracy would have its way through the markets, would have its way. It didn't work out. So I start my book off with that event because it nicely and dramatically, the Greek situation is still ongoing, but it nicely illustrates how politics and the markets interact. And politics today in most of the developed world, politics means democracy. And this interaction between politics and markets, while known, while recognized, I don't think its full implications have been recognized. And that's why I decided to write the book.
Yeah, with the bailout referendum, this is a massive debt. I believe it was 177% of Greece's GDP.
That's correct, yeah. It's probably different now. It's probably higher now. I haven't looked at the latest numbers. Yeah.
Even if they paid their entire output and didn't eat or, consume anything it would still take them almost 2 years to pay it off, which of course is unfeasible.
Yeah.
And then what they were doing, they were trying to refuse to pay it off. And I suppose they were hoping that markets would have a big reaction. And then when they didn't, it was sort of, their leverage was gone. They didn't have the bargaining power they thought they had.
That's correct, yes. The markets that the next day The referendum took place on a Sunday, and the next day, markets were down, not down significantly, specifically those in Europe, which would be more closely impacted. And the euro, which was the key financial instrument in this entire drama, barely reacted at all to the referendum result. Now, part of that was because by this point, I mentioned before that this is just drama that had started back in 2010. The reason why the market's reactions were muted is by this time, much of the debt that the Greeks had held were no longer held in private hands. In other words, they were not held by private market players, whether that be pension funds, commercial banks, hedge funds, and other institutional investors, but they had been effectively transferred to the government, whether to taxpayers or to central banks, who had started, even though this goes against the Maastricht Treaty that brought the euro into being, the central banks had started buying European bonds. And I'm talking here specifically about the European Central Bank. Yeah, so that's how it's played out. It's still currently playing out because Greece is back in the news, because part of the deal that was made in the aftermath of the 2015 referendum is that Greece would still have to comply with various fiscal policy requirements, and in order to get additional disbursements from the so-called troika. And the same party's in power. Tsipras continues to be in power, and they still, as you'd expect, they would rather pay less debt, or at least pay the debt on less onerous terms.
The odd thing is that people keep lending them money when they're so resistant to paying back their loans.
Yes. Yeah. And that brings up a larger question that I talk about in the book, which is the role of the bond markets. The bond market is one of the biggest of the financial markets. In the book, I go through the main ones. These would include the stock market, the derivatives market, which has grown dramatically since the early 1970s. I go through the currency market, which is the biggest one, at least on a per-day trading rate. But the bond market's huge. The bond market is a lot bigger than the stock market. It doesn't get as much public attention as the stock market does. It is not the subject of cocktail party conversation the way the stock market is. But the bond market is huge. It is a major lifeline for governments. Most governments today, it's hard to think of an exception among the democracies now. Most governments today do not finance their expenditures, their infrastructure, their social programs through taxes. They run deficits. Those deficits have effectively become perpetual. If you go back to the early 1970s, and we can come back to the issue why the early 1970s is such a critical date, but you go back to the early 1970s, you do find countries from time to time running fiscal surpluses or running balanced budgets, but for the most part, they're running deficits. And so as a result, since then, we've seen a sustained increase in the level of public debt as a percentage of GDP. And so we're getting close to levels that we haven't seen since World War II among the OECD nations. So the bond market is, it's a key player. I argue in the book that the bond market is an enabler of the worst fiscal habits of democratic states. The democratic political systems have an inherent tendency to overspend, and that the bond market becomes a very enticing place that politicians look to in order to finance the spending that helps them get them elected. And so then the question arises, why do the bond markets, so this is back to your question, why do the bond markets keep on buying the bonds of these increasingly indebted states? I'm not sure I have the complete answer to that question. That was one of those questions that really got me thinking as I was writing the book. I think tentatively the factors are these. The key one is the desire for safety that seems to be very strong in the human psyche. So I think we have to go into psychological explanations for this, that the thing about government bonds, unlike bonds that you would buy, say, from a corporation, which is the other major sector of the bond market, government bonds are backed by taxes. And so, and taxes have to be paid. They are coerced from people. You don't pay your taxes, you'll either you'll get fined, or in a worst case scenario, you will end up doing time. A corporation doesn't have the same ability to gather money. It has to rely on the voluntary decisions of the buyers of its products. So if you buy a bond in General Motors, you buy a bond in, say, Bell Canada or something like that, your ability to get money from that bond, and a bond is effectively by the way, a loan that an investor extends to an entity, a government or corporate entity. So when you buy a bond from Bell Canada or from some other private company, you got to rely on the fact that they're going to be able to get people to buy their goods and services voluntarily. When you buy a government bond, you have the assurance that the entity who's supposed to pay you back the money has the power to force people to give it money. And so that makes government bonds safer in general, all else being equal, than corporate bonds. And since people do crave safety, they do crave security. I don't want to get too much into the depths of human psychology here, but there's a deep-seated desire to avert risk, and this is well known and among financial academics. We talk about it all the time. We talk about it in terms of risk aversion as being part of the model that we use to depict investor behavior. So this is such a powerful desire to have safety when you invest your money, to know that if you plunk $1,000 now and you're promised 2% interest, you will get that money back and the 2% interest, at some future point in time. So I think that's the most powerful driver for the demand of government bonds. And that demand is so strong that investors will overlook the fiscal health of the countries to which they are effectively lending to. I think the other factor, too, is legislation. There, you look at the regulations, specifically pension funds, but also banks and so on have to operate under. They are required to have a certain percentage of what are deemed to be safe investments in their portfolios. By the way, this also includes insurance companies. And safe investments invariably, so this it's just another way in which the safety factor gets played out. Safe investments invariably encompass and tend to get restricted to government bonds. And so there's a built-in legislatively driven demand for government bonds. And this plays out significantly with the banks, the commercial banks. Commercial banks, because they have to show to regulators that they have a certain level of core equity in their balance sheets. You look at these regulations. These are the Basel regulations. They have traditionally incentivized banks to buy their country's bonds, and so you've got a situation where Greek commercial banks tend to own a disproportionate amount of Greek government bonds, or Italian commercial banks own a disproportionate amount of Italian government bonds. So you have the banking sector effectively forced, but through legislation, to have to finance the country's debt.
So just as a part of doing business, if you're a bank, you have to show that you're safe. There was this issue of during the financial crisis of these AAA rated mortgage securities. And if you think about it in terms of just, supply and demand and all these things, it's not clear why the rating is so important. But then when you think about, I need to prove to a third party that I am safe, then what others think your assets are worth, or how safe others think they are, becomes really important. And at least there's sort of a perverse element here where if you're lending to Iceland or Greece, you can maybe get a higher return while still maybe appearing safe because, you say, well, I've got all these government bonds, right? But of course, the fact that they're not safe is why they can give you that higher return. And, if you're managing a bank, you want to earn a high return but you still want to appear safe. And if you lose money, you want to lose money when everyone's losing money so that you can say, hey, it's not my fault, not personally at least. Yeah. That's another factor too, that everyone, and John Maynard Keynes, I don't agree with everything he says, but he's pretty good on this point on the behavior of investment managers. You have a huge incentive as an investment manager to go with the crowd, because if you're right with the crowd, okay, you can bask in the general adulation that all investment managers are receiving at that point in time, and you're generating nice returns for folks. But if things go awry, the crowd becomes more important as a kind of protection device against criticism, because you can always say, as you point out, that this is a systemic issue. I couldn't do anything about it. Everybody else also was adversely affected. And so that does tend to work in favor of government bonds, and does tend to overinflate the level of demand for government bonds relative to what they should get if you had a truly free market
people were just free to buy whatever bonds they thought would fit their risk return preferences. I think that's a key factor as to why I believe that bond markets end up not being vigilantes. There's this line, Eddie Ardeni, well-known analyst on Wall Street, came up with this line, this phrase, bond market vigilantes. I believe it was in the 1990s, and it supposedly referred to this group of people in the bond market who were always on the lookout for countries that were running fiscal deficits, that were doing the wrong things economically, and that these bond market vigilantes would pick on these countries by selling their bonds, shorting their bonds, and then putting those countries in a bind, supposedly, by raising the interest rates that they would have to pay anytime they issued bonds again. But the reality is that the bond market vigilante, if it exists too late. You look at the history of the bond market, and we're talking here a couple centuries now. The bond market is actually older than the stock market. You look at this market, and the vigilantes only come up really late in the game when it's pretty obvious that the government in question cannot pay. And so the bond market doesn't do, I would argue, it's the job that it advertises, namely always keeping yields in line with risk. It does tend to underestimate the level of risk, specifically with when it comes to governments.
Well, the thing about bonds is that they don't really have an upside, but they have this sort of dramatic downside where, you get a 2% bond, the best you can possibly do is 2%, at least in nominal terms, right?
Yeah.
But the worst you can do is lose all your money.
Right.
So there's this sort of fragility to bond markets, and of course, if you're a vigilante and you're going to sort of attack a country's bonds, then you're just, if they don't fail, you're just losing 2%, right? You're losing you're earning a certain loss at the risk of since you're doing the opposite, you have a large potential upside with a low probability. But
so you have asymmetric returns. Yeah.
So you also talk about the effect of politics on the stock market. You cite the Policy Uncertainty Project to determine what proportion of large stock market moves are attributable to political events. So can you talk about that project and how that data was gathered, and what does it tell us about the interaction between politics and the stock market? Yeah,
so that's a project designed to look at the the impact of uncertainty on economic events. So the group of scholars doing this, and then they cut across a number of universities, are not simply looking at uncertainty in the stock market, but also in the general economy to see whether or not, and to what extent, if it does, uncertainty affects general economic performance. So the particular graph that I've got there in the book, it's early on, is based on looking at the New York Times and trying and seeing and then looking on the days in which there is a 2.5% or greater movement in the S&P 500 index, and then checking the New York Times to see whether or not there was a political factor that was associated with that move. And so you look at that graph, and starting around 2007, 2008, starting around 2007, but then certainly accentuating in 2008, 2009. It's since stabilized a bit, but it's still relatively high. The number of big moves that can be attributed to political factors could include things like something happens in Congress, they pass a bill or they reject a bill, or a given country decides to initiate war against another one, or something along those lines. The level of political impact on the stock market has increased. And so I had to actually update that graph because the data, they stopped doing collecting the data, I believe it was after 2011, and I had to do it from 2012 to 2015. So in the last few years, it has abated somewhat. Part of it too is that we haven't, the level of volatility has also gone down. We haven't seen as many 2.5% moves as we did in the throes of the crisis and in the immediate aftermath. But that graph was there meant to illustrate the interactions between politics and finance, and a greater awareness, at least on the part of financial market players, or at least a greater reactivity among financial market players to political factors.
So does the New York Times have to attribute the move to a political factor, or do they just need to happen coincidentally?
Yeah, that's an interesting question. So every day, the major newspapers that have financial sections, or financial papers like the Wall Street Journal, they will offer some sort of summary of the market. And it does become a question, how does the writer for the newspaper in question determine what moves the market in that day? Because it's actually kind of difficult in certain circumstances to figure out, okay, why did the Dow Jones today go up 100 points? Why 3 days ago did it go down 200? These are not easy questions to answer. Reporters typically will answer that question by talking to market practitioners. They'll usually have contacts on Wall Street or on Bay Street in the case of Canada, and they'll always be on the phone with them or emailing them, and they'll get a sense of what the factors are based on those conversations. Another way in which the connection is made between a given move in the stock market and politics, if everybody's generally talking about it, this happened today, Trump got elected today, and look at what happened to the stock market. And so then the association automatically gets made. Sometimes it's pretty obvious. I think heading into the 2016 election, you could see pretty clear correlations between what was going on in the campaign, how what the perceived results of one of the debates and what happened in the market the next day. Certainly on the night of the election, you could see markets being affected by the poll numbers that were coming in. So bit of an art to try to figure out what political factors move the stock market.
Yeah. So, but at least with a 2.5% move, that's so large that it can't just be noise.
That's right. Exactly. Yeah.
I think I remember seeing, of course, the data from the Policy Uncertainty Project doesn't go back this far, but I remember seeing like a newspaper from the stock market crash that initiated the Great Depression, and elsewhere on the front page, or maybe it was not even the front page, there was the Senate vote on the Smoot-Hawley tariff, which I've seen drawn as a sort of a connection between, this big tariff that a lot of people were predicting would have terrible effects, and the big stock market move. And of course, the Great Depression followed from that, although it's not necessarily a one-to-one cause and effect thing, but
right.
Quite a dramatic historical example of a political event that potentially, it's a little controversial, could have caused a big stock market move. So I wanted to do a bit of an aside. I want to take a moment to describe the cover of your book. So there's a man flying a kite in a windstorm, and the kite looks like it's made of a giant dollar bill. I think, it looks great. It's a great metaphor, but I'm not quite sure what it means. Who is the man? What is the kite? What is the windstorm?
Okay, that's a good question, because I had various possibilities presented to me by the publisher with respect to different covers. I thought that was a good one because I thought it was visually nicer than the alternatives, but that's neither here nor there from the point of view of trying to see a connection between the illustration and the book's thesis. But I thought it did nicely on a gut level. It did capture the thesis. So when I first saw it, I thought, okay, money is very critical to understanding the financial markets. So this is one of the big points that I make in the book, and it's why the first word in my title is money, is that money, I argue, is the atomic unit of finance. It is the most elemental particle in finance. And so all the financial instruments that are traded in the markets, whether that be bonds, stocks, currencies, derivatives, they're either money. In the currency market, you're trading one country's money with another money, or you're dealing with promises with respect to money flows. Money is being traded for future money, or money is being traded for future money if a certain state of affairs occurs. So money is huge. That is the thesis of my book, that it percolates throughout the entire financial system. And so I think that explains why that kite is made of money. I would say the person there would be democracy. It would be government. And government, my thesis is that in the interaction between politics and finance, that relationship is commonly drawn as a kind of battle between two equal foes, that there's a tension. You often see this outside of financial markets where people talk of state versus markets, where markets is sort of the economy. I argue that no, it's we're not talking about two equal players. We're talking about two significant players, but where the more powerful player is the state. So I would say that the state is now the one that controls the money, hence why it's holding the kite. It doesn't always, as when you're flying a kite, that the kite doesn't always do what you want, and so I think the difficulty of dealing with the kite reflects the difficulties that the state has in managing the money supply. And then in the other part of the illustration for the book, you've got other people sort of cowering, and I think that nicely evokes how the financial markets have been distorted by politics. That's my claim, and specifically by democratic politics, from being able to realize the good, fully realize the good. I mean, there's a lot of good that financial markets do despite democracy and despite politics, but that it could do a lot more, and it wouldn't be as damaging as it is in many respects if democracy wasn't there to distort the functioning of money and then from there, the world of finance in general.
Yeah, and you do draw this connection between democracy and distortion of money. And in particular, you have two chapters, money before liberal democracy and money in liberal democracy.
That's right.
And and so you talk about the history. So with the 20th century, you sort of get our modern liberal democracies. You also get this transition from mostly deflationary currencies tied to or actually made of precious metals to inflationary currencies loosely tied to precious metals, but eventually just completely fiat paper money. And there's this, you have graphs in here of the sort of the movement in the price level in UK and the US, just sort of gradually falling, and then 20th century starts, and then they sort of gradually rise from there on out. And there's this transition at that point. So maybe tell me a little bit about what changed politically, and how did that lead to the change of the money?
Okay. Yeah, those are very important chapters. They sort of set up the discussion for each of the separate financial markets. So basically the story goes like this. Before liberal democracy, governments were known to abuse their power over the money supply. We're not really 100% sure where money comes from. Economists, of course, have a nice tidy story that it comes from the fact that people specialize, then they realize they have to trade, and then you initially trade through barter, that is to say through the exchange of real goods and services, but then people realize just how inconvenient that is, and then people decide to use a specific object as money to be accepted in all exchanges. The story there is a bit more complicated. Anthropologists would tell you that it's not that neat. But in any case, money goes back to Lydia. That's when it was first coined. It appears to have essentially have originated with private merchants, but then it was taken over by the state, and it has become a monopoly of the state ever since. And ever since, it has abused that privilege by cheapening the currency. And cheapening the currency, meaning that the content of the metal in each of the coins would be chipped away, even though their nominal value would remain the same. And so heading into liberal democracy, so you go, let's go now to the 18th century, where this changes first start to get their origins. You go back to the beginnings of liberal democracy. Let's use the United States as the example. They actually had a founding where they had to construct a constitution. It was well known at that point in time that the states were liable to abuse their power over the money supply and essentially take purchasing power away from some members of the community and transfer that purchasing power to the state. and to the state's various supporters. So when the liberal democracy got started, the elites knew this was an issue, and so they accepted the idea that the money needed to be moored to something objective, to something beyond the power of government to control, and that was precious metals and principally gold, although silver also played a role. And so you go back to the United States Constitution, it actually prohibits to the states only, but not to the federal government, but it prohibits to the states the emission of paper money. And you actually go to the Federalist Papers, and paper money is discussed there, and paper money, it is viewed as something that will undermine the morals of people and undermine democracy. And so that's in the 19th century, this lesson was still institutionalized and in the few democracies that were then in existence. Mainly at that point in time, in the 19th century, you're talking about Britain and you're talking about the United States. This idea of money being tied to something tangible outside of the power of the state reaches its zenith with the classical gold standard, which prevailed roughly from 1870 to 1914. The United States got into it a bit later than 1870 because of the Civil War. Great Britain was in it from the beginning. It actually had gold standard in operation since about 1820 or so around there. I can't remember the exact dates, but since the end of the Napoleonic Wars. And so what changed? Well, one factor was World War I. That certainly was key because governments needed to spend money to finance the war. It was a brutal war, and it dragged on a lot longer than people expected. And so governments then did appeal to inflationary finance. Essentially printing money. And to do that, they had to leave the gold standard. The idea was to come back to the gold standard. They did come back to the gold standard, but it wasn't exactly like the classical gold standard. It's what we call a gold exchange standard. It was a system in which Britain and the United States were the anchors. It didn't work too well, and not because gold is a bad standard, but because the system itself was framed poorly. And then this all came to a head at the beginning of the Great Depression. And at that point in time, you've got more democracies, you got more people enfranchised. So in the 19th century, in the democracies that then existed, the franchise was limited. It tended to be limited to males holding a certain amount of property. The franchise was extended in the afterwards, and you especially saw this in the 1920s. And at that point in time, you've got a bigger part of the population who are bearing the brunt of the adjustment that is necessary with a gold standard. So when you have a gold standard and things start going south, then you've got to tighten the money supply, assuming you're a country that you have gold is flowing out of your country. And that requires that prices go down, including the price of your labor, wages. And to the extent you got more workers, more of the laboring class voting, they're not going to be too happy with that. So that pressure, the fact that you've got people now voting that politicians have to be worried about, who bear the brunt of an adjustment during a crisis in a gold standard, that was key. That was very key. And so after the 1930s, a lot of countries go off the gold standard. It does get revived with Bretton Woods in 1945, but it was never really the same as the classical gold standard from 1870 to 1913. Bretton Woods did last, although it was pretty much on its last legs by the mid-1960s, and it fell apart officially in 1971 when Nixon closed the gold window.
Right. And I remember hearing that even during most of this period, a lot of people didn't even understand the connection between gold and the paper money they were actually exchanging. I think there's one story where an economist was having dentists used to fill in cavities with a bit of gold, and an economist was at his dentist, and he asked him, "Hey, do you know how much you've been paying for gold over the last, since you've been a dentist?" And dentist goes and checks and he says, I've actually been paying exactly the same amount the whole time.
Yes.
And of course, at that point it was tied to gold. And so of course you paid exactly, a certain amount because your money officially, like its value was pegged to a certain amount of gold. And so
that's right.
So it couldn't fluctuate. But your average person, they traded bills and coins that were themselves not valuable but were ultimately redeemable for small amounts of gold. But to them, it was much like today. They were just trading paper money for all they cared, and they still do. I mean, now we trade electronic money for the most part, but there was, I think, to the average person, they pick up the newspaper and hear Nixon has closed the gold window, and they flip to another page, right? Sports section or something.
Yeah.
There's this sort of strange thing where the people voting don't necessarily understand the monetary system, and yet they have such a big effect on it.
That's true. And that's one of the factors I point to in arguing that there's a tension between democracy and the gold standard. Voters do not have a lot of information about the things that they are asked to vote for. Ilya Somin is very good on this. Recently, Jason Brennan has written a nice book called Against Democracy, where he goes through the evidence of voter ignorance. A lot of voter ignorance is rational. Rational ignorance, as the economists would refer to it, in the sense that in order to become informed about all these issues, in order to become informed about what is ultimately backing the monetary system, or how the monetary system ultimately works in a fiat versus a gold standard system, it takes a lot of time. You only have one vote. The chances that your one vote's going to make the difference in an election is so infinitesimally small that if you compare the benefits of acquiring that information in terms of your ability to influence the vote versus the costs of acquiring that information, the cost benefit is not there. So most people end up really not knowing how these things work. I think the gold standard does have the virtue, though, at least back before the gold window was closed, back when Bretton Woods was at its heyday, back during the classical gold standard period, at least people had some vague sense that there was something backing it up. Today, I think if you were to ask somebody on the street, what ultimately backs up this piece of paper, they would either look at you mysteriously as if to wonder, like, does there need to be something to back it up? Or they would tell you, well, I think it's the government, right? And this is a factor, Joseph Salerno talks about this, that why gold ultimately was abandoned is that it lost its resonance in people's everyday lives. With each new iteration of the gold standard, because in the classical gold standard, you could actually go to the bank and literally exchange your money for gold. And so the connection day to day between the bills you had in your wallet and gold was much closer. With Bretton Woods, though there was this $35 per ounce price on the US dollar price on gold, the only people who could trade US dollars for the gold were central banks. Not individuals like you and me. So with Bretton Woods, there was this distance between the money and the gold. And then I would argue, I have to agree here with Joe Salerno on this point, that that was a factor that facilitated the government's ability to close the gold window in 1971. Because if you go back to the 1920s, when the whole issue, there was a big debate about whether or not Britain should go back to the gold standard in the 1920s. Winston Churchill was then the Minister of the Exchequer, I believe is the term for the British equivalent of the finance minister. And there was a big debate at the time, the 1920s. And it was clear from if you look back at the records of the debate, that the population, the public opinion at the time, had this sort of sense that about gold, that it's like the ultimate source of value, and therefore a monetary system that wasn't backed up by it was somehow dubious. But that sense had been lost by the 1970s when Nixon made his decision. And I think that had to do with the fact that the dentist couldn't figure out what the price was.
Yeah. I kind of want to jump back in time a little bit in your Money Before Liberal Democracy chapter. Part of the reason people, when they were setting up the United States, in the 18th, 19th, and at least in the 18th and 19th centuries, were so skeptical of paper money is this event, the Mississippi Scheme, perpetrated by John Law, a Scottish-born banker. I wonder if you could talk a little bit about that, because it's such an interesting event.
Yes, that event was very formative in terms of framing the opinions of political elites at the time when liberal democracy started in the United States and its beginnings in Britain after 1688, after the Glorious Revolution. So John Law was quite a character, womanizer, gambler, by night, but by day he liked reading books on economics and finance. And so the story goes that he would be in these casinos at night, playing roulette, and he would hobnob with the nobility, and he major political official in France. And so when Louis XIV died, he suddenly, and after Louis XIV died, France was in complete fiscal shambles. France had fought all these ruinous wars, or financially ruinous wars at least. And the court of Louis XIV was notoriously lavish. And so when the regent of France, because the successor was too young, he remembered meeting John Law and thinking, well, okay, this seems like a smart guy. So Law was brought in to see if he could fix the problems of France. And the idea arose of coming up with a bank that would create paper money. Initially, the paper money was supposed to be backed by land assets. And Law's thinking was that he wrote a book. It's actually quite an interesting read, where he discussed this. And his main thesis was that in order for economies to function optimally, they need a lot of money. They need a lot of greasing of the economic wheels. And so he was sort of an early monetarist that high levels of money in the economy tend to create more economic activity. Although he was not a monetarist who was too worried about inflation, but he saw the key role that money played in getting economic activity percolating. And he also felt that low levels of money tended to hinder economic activity and therefore needed to be avoided. So he was looking for ways to increase the money supply. And he didn't like the precious metal backup because he thought that was too volatile. Specifically, he was thinking of silver. And so he thought, why don't we just go on the basis of land? The supply of land is fairly fixed. It's perfectly fixed, really. And so we could build a monetary system on that. So the French monarchy bought into it. They started this bank. The bank then became part of this further operations with this company that was involved in the Mississippi. Mississippi then didn't refer to simply a state, but it referred to pretty much a batch of North America that runs from the Great Lakes down to the Gulf of Mexico, and it was controlled by France. At the time, this company in Mississippi was tied in with this bank that had been set up, and Law had gotten a lot of people to buy into the shares of his company on the argument that Mississippi had all this economic fortune to be had. The problem was that the French monarchy used the bank as a money-making machine, and it caught up to Law, and a huge inflation arose as a result. Also, what happened too is that the stock price had this bubble. Mississippi company created all this sort of excitement in Paris's then financial district, and then it just crashed. And Law ended up escaping with his life because his life was at risk. He ended up dying a pauper in Venice. So that whole event, that was one of the first paper money experiments in Western history because it was so bad, because it ended so disastrously for the French economy. It became this lesson that reverberated for centuries after, and certainly informed the founding of the United States about the dangers of excess paper money creation. And also in the United States too, key also in realizing why they were so negative about paper money was the experience of the different colonies. The United States was made up of colonies, British colonies, separate colonies prior to them uniting and revolting against Britain and becoming the United States. And a number of these colonies during the earlier part of the 18th century ran into these inflationary problems from excess creation of money, like Rhode Island being the most classic example of that. So when liberal democracy had started, they had all these historical examples, the Mississippi Company chief among them, telling them that paper money was quite dangerous, and you needed a lot of political constraints around that paper to make sure that it didn't damage the social fabric.
Okay, so I actually am really interested in John Law, partly because I have a personal connection to him. So my wife's last name is Law, and I was speaking to her grandfather, who said that a cousin of his had done the family genealogy and potentially found a family connection to the John Law. Actually, if you visit the UK to this day, and your name is Law, people will say, "Oh, any relation to John Law?" Even though it's been 300 years. If you're in Europe, people are still sore about that because it was such a fiasco.
Yes,
so
yes.
I've inadvertently, potentially at least, married into John Law's family line 3 centuries later. You say he's like a monetarist. This is, of course, before Adam Smith, so before modern economics even existed at all. And there's also this, but I've also heard him sort of put up as like a proto-Keynesian sort of, the idea that you could stimulate the economy by printing money and by expanding the money supply, when it's in some kind of recession, to sort of push the economy out of a recession. And of course, that's got to be a huge factor in the whole thesis of your book, which is the interaction between politics and finance, is that there's this idea that the politicians can use finance and use their control of money to try to, steer the economy and keep it from overheating or crashing. So let's talk a little bit about that and about how are democracies at dealing with business cycles.
Yeah, that's a great question. And I fully agree with your point that John Law can be viewed as a proto-early Keynesian. And I think that is why he has a much better reputation today than he did in the 18th and 19th centuries, precisely because Keynesian economics is now more in vogue. And you read some of the accounts of the Mississippi Company scheme today, and I'm a lot more sympathetic than earlier accounts, in which Law is not faulted for the idea of paper money as such, or the idea that money can stimulate the economy, but more just for the poor execution, or that he was a victim of the French government using the bank that he had set up as a money machine. That if in terms of the democracy and monetary policy in general, my thesis is that democracies are inherently in tension with any kind of policy framework that puts a constraint on their ability to create as much money as they want. And the gold standard, and this is why the gold standard ultimately fell apart. I think I use this line in the book that it was in the DNA of democracy ultimately for the gold standard to be abandoned, because the two ultimately, while they are not necessarily at odds, I mean, this is part of my sort of solution I propose at the end, but there's certainly a tension there. And so democracies have an inherent tendency to overproduce money. My argument is for this is twofold. There are two major factors, I argue. One is democracies, from a value standpoint, democracies are committed to freedom and equality. Every political regime has a moral ethos associated with it. Aristocratic and monarchic regimes tend to have more hierarchical, inegalitarian moral systems associated with it. But democracies, because everybody has the same vote, everybody has an equal share, they tend to prioritize equality. And because being equal means you're not enslaved to another, you're not subordinate to someone else, they also tend to prize freedom. And of those two values, however, equality tends to exert itself more over time. This is a point that Alexis de Tocqueville makes in his book, Democracy in America, written in the 1840s. And I think it's a point that history has borne him out on. And so equality is a major value. You look at the major social changes that have affected democracy, changed democracy, you can interpret them as attempts to institutionalize the norm of equality. Whether it's the rise of unions, the rise of workers' rights, whether it's the desire for the movement for women's rights, civil rights, you name it. Pretty much every major social change in democracy over the last century or so has been instigated by the desire for equality. And I'm not and equality, and I'm not in critiquing and using this as a factor for why democracies overproduce money. I'm not saying equality is a bad value or anything like that. I'm just trying to sort of state the facts. This is what's happening. So that equality norm ends up playing out in political impulse toward redistribution, and specifically the introduction of social programs, that are designed to redistribute funds from the better off, the more prosperous members of the community to the less prosperous members of the community. So there's that pressure there. There's that imperative there in our democracies. The other one is what I call the class conflict between the taxpayers and tax consumers. And this is not my idea. You see this in the writings of Murray Rothbard, for example. But tax consumers, whenever you have a state needs to operate. It'll have to get taxes. Someone's got to pay them. And at that very point, you have two separate classes that develop. The taxpayers are the ones who pay the tax in order to finance the state's operations. The state needs money to operate. It needs to hire people. It needs buildings in which the people can work in. It needs to pay for the weapons in order to provide for national defense and equip the cops and so on. And then you've got the tax consumers, because there are people who work for the state. There are people who will benefit from the state in terms of maybe getting favors from the state. And so you've got these two classes. So my argument here is that with democracy is that given the economic situation that we live in the modern world, the distribution of income is always such that democratic politicians, in their attempt to get a majority, their incentive is always to offer this majority, the 50% plus one, programs, money effectively, and have someone else pay for it, have the minority pay for it. And so this is why you get states, the democratic state has an imperative to grow, because politicians have an incentive to build coalitions among the middle class and less wealthy part of the communities, offer them social programs, offer them infrastructure, offer them public goods, basically, at the expense of those who won't vote for them. So you can get this going for a while. Politicians will outbid each other as they offer goodies to the public. This will expand the state. But at a certain point, though, the taxpayer class will resist. A lot of the tax consumers will find themselves being asked to pay the taxes for the things that they vote for the goodies that the politicians have offered them, and they'll start to resist. And at that point, the politicians have two avenues that they can go. They have three options. They can either raise taxes, which is not the most politically advantageous one, which leaves the other two, which is you go to the bond market, and I've already discussed how the bond market ends up being an enabler of the state's fiscal propensities. And the other one is monetary creation. You essentially print money to pay off all the goodies that you've provided to voters. So unless there's some sort of constraint on democracy, then you will get rising public debt levels. And the constraint that used to exist was the gold standard. But since that has gone away, since the early 1970s, I've already mentioned this, but now I can then mention the key factor that led to this. But since the 1970s, I have a graph in the book that illustrates this. You've seen a steady rise among OECD nations in the public debt held as a percentage of GDP. The rise has been pretty much inexorable since then, and it has only accelerated since the financial crisis.
Okay. So, and then, of course, we were talking about business cycles in particular. We, of course, you have a particular theory of the relationship between money and the business cycle, and, of course, it's wrought with controversy because it's so hard to establish these things. But if a government can both pay its debts and maybe, grease the wheels, as you said before, of the economy and make things go better, it would seem to be a win-win, right? They get the money to pay for the goodies that get them elected, but they can do it without crippling the economy, at least in the short term. And so that's right, I guess that's where this transition from deflation, 2% deflation every year to 2% inflation every year, and sometimes much more, that we see in the 20th century. Do you have any closing thoughts, anything we didn't cover in this conversation?
I would just point out that I think in terms of, I'm often asked, okay, George, you've given a pretty negative view here of democracy's relationship to money and the financial markets. But one of the things I also talk about in the book is that we're going to have to live with democracy. In stating all these criticisms of democracy, I don't for a moment want to replace democracy. The alternatives are much worse, but we have to be aware with all the benefits that come with democracy. I mean, it is definitely the best bet that we have for preserving human dignity of all the different regimes that are out there. while recognizing the virtues of democracy, we do have to be attentive to its defects and try to counter them as best we can within the limits of democracy. So I'm often asked here, what's your solution if democracy creates all these problems, but then you're also saying that democracy is not something we want to go away from? So what is your solution? And I got to say, that's a tough question. In the book, I left that obviously to the end, and I didn't spend as much time on the solution as I did in the description of the problem. So diagnosis ended up getting a lot more attention than prescription. And that's because prescription is very hard here. But I think the key thing that needs to happen is because in a democracy, ultimately the people rule. That's what defines a democracy. The many rule. That's Aristotle's famous definition. Any change towards the better with respect to our financial system will have to come from a change in public opinion. And I mentioned earlier how in the 1920s people had a kind of sacral view of gold, that gold was this wondrous entity with all these wonderful aspects in preserving the stability of our purchasing power. I'm not saying we need to sort of create a new mythology about gold. I mean, gold at the end of the day is just a metal that happens to be quite scarce, and for that reason can be the foundation of a monetary system. But we do need a change in public opinion where gold is once again seen as a core part of the monetary system. How do you get there from here, where people seem to be okay with the fiat system that we currently live under, as long as the inflation doesn't get too high, as long as it doesn't get too much above the 2% that you mentioned? I think I think you will need some sort of big crisis, because one of the things I found in writing this book and the research is that when it comes to things financial, and when it comes to the regulation of the financial markets, you get periods of stability where nothing really much happens in terms of the regulatory framework. You get a little change here, a little change there, but then you get a crisis, you get a crash, like 1929, or you get something like recently happened in 2008, or you get the dot-com bomb which we got into 2000. And that changes the political correlation of forces. Suddenly it empowers certain groups, certain interest groups, certain arguments that before weren't getting much of a hearing. And so I think that is. I'm not hoping for such a crisis, although my reading of how monetary systems work suggests that such crises are inevitable to the system, and it's just a matter of time. It's a matter of when rather than if we get another one. But so that's, I think, we need a change in public opinion. As Ludwig von Mises pointed out, ultimately the public rules. Public opinion ultimately decides how the society is economically run. And right now that's in favor of fiat. That causes all sorts of problems, which the public is not fully aware of. We need to get that opinion changed to something more amicable towards gold.
My guest today has been George Bragues. George, thanks for being part of Economics Detective Radio.
Thank you for having me.